Hello and welcome to our compliance catch-up. My name is James Hogbin. People are joining. I should wait for people to join. Look at that. First time we've done this on Teams, and I started too early. Right, there we go. Some joiners. Hello, everybody. My name is James Hogbin. I'm the CEO of Fingerprint Supervision, and I'll be hosting the discussion today. We as Fingerprint provide a platform that automates electronic communication and voice supervision, passing operational due diligence, regulatory investigations and annual audits, as well as meeting day-to-day compliance policy KPIs. Fingerprint is a system that allows service providers to offer supervision as a service to their network of clients. So we discuss an awful lot with service providers and principals what their key areas of concerns are. AML and financial crime often comes out as their top of mind subject, so we thought it was time for us to take a deeper dive into the subject. Today, to do that, I am joined by an outstanding cohort of experts in AML, KYC, financial crime and regulatory AI. Marika Kernert, who is MLRO of Evelyn Partners and head of the HSBC financial crime function. Anastasia Lewis, who has deep compliance experience at Gresham House and Cheney Capital. And Arig Nejan, who's a Reg AI expert, maths genius, and a founder of Cardamom AI. Marique, please, would you introduce yourself?
Thank you, James. So my name is Marika Kernert, as James has introduced me. I am now a consultant, but I started my career as a lawyer and then came to the bright side of financial crime and compliance, and have worked in institutions big institutions such as HSBC, smaller institution like Evelyn Partners, where I was the MLRO until fairly recently. So sort of array. I've seen a lot of different things. And now I am consulting on my own, helping firms to navigate their navigation in terms of financial crime with all matters of financial crime. And I have a specific interest now in trying to see how AI can support firms into their financial crime controls, in particular CDD, which I think where fraud is quite developed, CDD a little bit less, and it's a work in progress.
Yeah. Thanks, Marika. I'll go next. I'm Anastasia, the co-founder of Alira Solutions. Similarly to Marika, I have spent my whole career so far in in-house compliance teams and have more recently set up a compliance consultancy that's predominantly kind of working in 3 tiers, as I like to call it: the BAU execution within compliance frameworks and teams, then moving into framework review and redesign, and then finally kind of future-proofing teams to be able to manage regulatory load, which we'll go on to talk about, and help firms scale efficiently within their compliance teams.
I'll go next. Thanks, Anastasia. Thanks, everyone else. My name is Arig. I'm the CEO and co-founder of Cardamom. We help regulated brands launch products, enter new markets, and stay compliant 10x faster by automating the most manual bits of reg compliance. So think horizon scanning, regulatory mapping. We work with some of the most recognizable sort of fintechs and tier ones. Before that, I used to work at Revolut for 4 years as a product owner. So I was on the sort of other side of compliance, focusing on launching retail investment products like ETFs and stocks to millions of users. And keeping up with regulations and understanding them, how to apply them, was one of our biggest challenges. And that's why we started Cardamom. James, I think you're on mute.
I love this system. So thank you very much, everybody, for joining us. What a great panel. In putting together this section, I did some research. And I discovered an awful lot about AML that I never knew. Specifically, the FCA has responsibility for all of the professional services AML through an organization called OBAS. And OBAS is a body that sets the rules and also reports whether they're any good. And in July 24, they turned around and said, sorry, July 25, they turned around and said, this year, no material improvement whatsoever. In fact, just this month, they've censured the Bookkeeping Institute for poor AML in its members. So the FCA's own body is saying things aren't going so dreadfully well. The FCA did a study, financial crime in corporate finance, in October 25, where they themselves said 2/3 of the firms surveyed were not compliant. And more concerning, a third of principals, and if people don't understand the principal model, a principal sits up here and they host loads and loads of ARs that people talk to. A third of the principals who host the ARs do no risk assessments whatsoever. So, to my innocent research, it seems that AML is not really improving despite all of the messages we're getting. Marika, what's your take on this as the ex-MLRO and FinCrime person for some major institute? Where do you stand on all of this?
So I think on the macro level, AML or AML prevention really is really improving, generally speaking, but incrementally. The problem is there are always new ways for criminals to try and get into the system and use institutions to further their means. So it's also a matter of now the FCA and other regulators are looking more into the smaller firms. They really had a sort of risk-based approach that looked at the bigger firms first. And now when you're getting into the details and the smaller firms, because you're only as strong as your weakest link. And if you don't have the resources because you're a small firm, then actually criminal can go from bigger institutions they can't actually have access to anymore to smaller ones. And I think this is probably what we are seeing, is that generally speaking, it looks like it's not improving, but the general knowledge and understanding and the controls is improving. However, we are faced with criminals who are always very creative and improving too.
And do you think that it's something that big organizations who are more scared of the regulator and censure have taken more seriously to begin with, and smaller firms have said, well, all the fines and all of the bits and pieces are going to the big guys, we don't need to do anything about it?
I think realistically, some of it is, yes, this is a little bit the mindset. I think this is changing. I think there is a bigger understanding of AML and financial crime matters now because, it's a focus of the regulator. There's a lot of talk about it. If you include fraud in it, people are very focused towards that. But I think for a long time, the idea was more towards, I see this regulation. I'm going to have a program that is very tick a box. I'm very small. My risk is not big. I have only very low risk clients. I'm in the UK. Then I'm just, doing the bare minimum. And now that bare minimum that the regulator is expecting is a lot higher than it used to be.
Anastasia, you've worked for slightly smaller organizations than HSBC in your compliance journey. Where do you see AML, KYC, and all of those bits and pieces? How is that in the mix of the entire compliance day to day?
Well, it's interesting, James, you were saying, larger firms are more nervous about getting it right. But when you look at enforcement, it's the large firms that are getting very similar fines for what small firms are failing at still. So I reckon the actual landscape and framework is probably quite similar. And I'd agree with what Marique was saying. People know, they have the knowledge and understanding, but it's that balance between them putting that into practice. And I think sometimes where there's been enforcement for failures in policies, procedures, record keeping, there's not actually been any breaches to enforce fines on, because actually in practice, firms are probably doing more and perhaps not just documenting it very well. And I think that's kind of a key thing to reinforce around not only what you were saying earlier, James, about the fast pace of change. The more pace of change, the more you kind of have to document your decisions, whether that be through risk assessment, whether that being through board communications, whatever you feel is appropriate to your kind of size and risk profile, but definitely make a record of why you've made certain decisions. And I think that will filter through as good practice to the regulator versus someone that hasn't got anything and doesn't have record keeping, but they might have a really robust in practice approach. So I think tying all of those together in an environment that's moving really fast is really critical for any size of business.
And Eric, when you're doing your horizon scanning with your AI bits and pieces, how much movement are you seeing in the regulatory framework around AML, KYC, and the proportionality of it and the risk-based approach of it?
Yeah, for sure. I mean, I think in terms of the rate of change in the movement, I think it's definitely seen as a key sort of focus area across regulators. And I think just to add to the point around being a small or large firm, a lot of the time, even these fintechs, like if you take a Revolut where I worked, it's actually going multi-jurisdiction where the pain points really start happening, because let's say you're only tracking the UK, that's quite manageable, but we've actually had instances where, you know, people are trying to harmonize across not just Europe and UK, but countries within Europe, whether that's Netherlands or Belgium, they'll have their own gold plating. So I think that's where really the complexity starts, and it might be small changes, but unless you're aware of them, to Anastasia's point, you might not be able to show that you're actually compliant, and that's where some of these fines might start racking up, from what we're seeing anyway.
And do we think that because a lot of firms outsource this, that they see it as a solved problem from somebody else? So it's fairly common in the asset management world to effectively do your KYC and AML through the fund, the administrator, a third party. Obviously, under CISC 8, the regulator tells you how to outsource and you need to set KPIs and all the rest of it. I'm unaware of anybody that ever does that. But do you think there is an out of sight, out of mind issue in this whole area? Anastasia, you've worked for the sort of smaller firm. I'm going to pick on you. Was it an outsourced thing and therefore you just check the outsource occasionally on a sampling basis, or was it a KPI driven CISC 8 regarded outsourcing in?
I'd say outsourcing is a really good point around all of this, because it's not really even just about the outsourcing to physical third parties like your administrator. You're also kind of coming into that tech space now where you're looking at what kind of providers, for those that traditionally used to do onboarding in-house, for clients, you know, those that did have retail clients will do. It's not only an administrator problem, it's also now a tech problem. How do you manage the tech and the admin on a similar kind of consistent approach? And I think outsourcing, and we'll move on to kind of bridging silos, hopefully a bit down the line with this conversation. But the importance is kind of considering from an operational resilience perspective, what is the impact that the failure in someone or a technological provider doing this wrong, what impact does that have on your organization when you're outsourcing? So even where you don't have KPIs specifically, though I know in organizations I've worked with, we did have to go into those organizations and do full and robust due diligence on an annual basis or on a periodic basis as appropriate. At the end of the day, regardless of to whom or to what you're outsourcing, your obligations remain the same. And it's a really good point that your systems and controls have to extend out to third-party providers, whatever that looks like. And Marique will have had probably a similar experience to that.
Yeah, absolutely. I was actually thinking about an experience that I've seen, which is anecdotal, but it really does show that we were relying entirely on a service provider, and that service provider did not update their sanctions list in time. By in time, I mean for several weeks. And at the end of the day, we were the ones, as the institution who had outsourced this to the service provider to a certain extent, we had to do a notification, and the responsibility stays with the institution, not to the outsourced party. So you can have your contractual arrangement in place, that's fine. But if you are looking at it as in pure reliance, but also the responsibility goes away, it just doesn't work that way. So you have to be very careful and around that. And that problem that you mentioned is then impacting several different firms who deal with it in their own little way, which is not always very efficient.
And here's the ticklish thing. Having looked at what is expected in AML, KYC, fin crime, and the rest of it, do we think what's being asked is proportionate to the people that it's being asked from? Because not only are you supposed to know where your client is, who they are, where the money's coming from, how they earned the money, you're supposed also to look through your client to potentially the other counterparties, and you're supposed to look through other vendors in the chain. So say you're a bank, you have to look through the market to the fund that's buying and selling these things. Do we think that it's realistic that you can be asked to do that? And is it a proportionate approach to this whole area within the industry? Marie, you've obviously worked at the big institutions. I can imagine teaching that elephant to dance would be a difficult thing.
Yeah, someone akin to it as trying to maneuver a tanker. And it was, but you do have programs with very different teams. And so my team was responsible for an area, but I had colleagues who were very specialized in that thing, in that particular area. If you are in a smaller institution, it is getting very complicated to be trying to catch up with everything that you're expected to do, but also that you think you are expected to do, because sometimes you hear these lovely letters, you see these letters, you hear the speeches, and you think, oh, I need to catch up because I'm not entirely sure that I am on top of this particular topic. And what you find out is that you can really get overwhelmed with the amount of things that you have to do. And then you end up talking about it and not really doing much about it, which is a very common issue, I would say.
And Eric, when you're doing your approach to all of this, obviously there's the regulations, whatever. When you're advising firms, how are you saying, well, actually, tough luck. Not only do you have to do it for yourself, you have to put in processes that somehow allow you access to other organizations, programs, and processes to ensure things are happening. Do you get any pushback when you're advising that?
Yeah, great question. I think to understand that, you sort of have to look at this as sort of 3 steps. First is knowing that there's a change or there's a regulation you need to comply with. Second is understanding what that means for you. And then third, and probably the largest, bucket, is actually implementing it, to your point. I think from what we're seeing is that, if you are a larger firm, then you have enough resources to sort of pull this together, and you might need some orchestration, which is sort of where we come in. So imagine that you're, in South Africa and you want to understand regulations there. You probably don't want to, hire a whole team in South Africa, which is why you might use technology. But imagine you're a smaller fintech, to your point. I think you're going to be looking at, using a vendor for the first couple bits, but then also empowering your existing team to help do those more complicated things that you said, because unfortunately, or fortunately, however you look at it, the smaller companies also have to comply with the same regulations, and they have to sort of jump through the same hoops. And so they need to find a way to keep up, because they might not have the resources to hire an entire team. So I think from our perspective, we'll help them understand the regulations, and then they might have to go to another vendor, for example, or use some consultants to sort of fill in that gap. But I think that's something which is becoming more and more available to them through technology.
And so one of the key themes of all of the regulation is taking a risk-based approach, which brings us on to AML. I think or KYC was a one-time thing. It was a one and done. We've checked that this person is who they are. We've checked that. We never need to look at them again, and the rest of it. And actually now behavioural markers are much more appropriate. We've seen in the US, the FinCEN have wanted implementation of people's behaviours as a key marker of doing the wrong thing. How has that journey changed, Marie, from when you first started looking at to now, where you've gone from checkbox to probably some more sophisticated markers?
So the journey's been really interesting, and the expectations from the regulators have changed in that there is a lot more focus, as you said, on the risk-based approach and proportionality, and that's where the FCA's new reform are supposed to lead us to. Be more proportionate and focus more resourcing on the higher risk. Now, if we want to do a better job, then the rules are interesting and they provide a framework. But when you are dealing with dynamic risks that are changing all the time, emerging and going away for a long time, changing forms as well, using new technologies, then it really is important to understand your risk, to have a proper risk-based approach. In order to do that, it can be quite difficult if you are not a big actors and you don't have a lot of resource. That's where, third-party and consultants come into play.
And Anastasia, your experience, how much was the behaviour of what people were doing as important as the lexicon-based or process-based or checkpoint-based approach to compliance? How was that beginning to impact the day-to-day of the compliance department?
Yeah, I guess maybe let's start talking about kind of why behavior-based monitoring is important, and that is for timely self-disclosure, for example, in some instances, but also early detection can lead you to kind of make preventative measures to make sure that you don't get to a point where you need to make disclosures. And I think regulators definitely expect you to look at behaviors or conduct in the SMCR language to determine what's happening within an organization. And that behavior or conduct monitoring helps enable boards to create their risk appetites, right? So it should be a cycle between compliance, behavior and monitoring and conduct monitoring, reporting to the board communicating back whether they're comfortable with the risk appetite that exists within a business, and that then moving down into risk frameworks and compliance frameworks. I think traditionally what's happened is, obviously we hear compliance being the risk for the police force, of a business, but the reality is I think in teams or in firms where that's the case, the compliance teams have just had to put extra risk averse frameworks because the communication isn't there between themselves and the boards. So I think tech can both be used for the behavior analysis point, but also tech can really enable that communication so that the board can set the right risk appetite for the business.
And Arig, you're an AI expert. How can we use AI in a regulatorily safe manner to identify behaviours that potentially we couldn't before? How can we surface those risks to help compliance and MLROs, SMF 16s and 17s to actually do a better job?
Yeah, I think it's really important to say that firstly, I think there are some great use cases for AI, and there are some things that it can't do as well as some people would like to think so. So I think what it does well at what it does well in is analyzing large sort of sets of data. And with this behavioral piece, you're looking at incredibly large data sets. Now, of course, for it to do the job properly, it would need to understand the context of what it's doing and why it's doing it. And also understand what the expected output is as well. So I think there's a lot of different pieces which need to come together. But if you can fit the infrastructure around the models that you're using, then you can get some very powerful outcomes. I will definitely say with a caveat that like nothing it produces should be taken as sort of gospel or the truth, right? Like that needs to be definitely checked. And I think, the human in the loop piece, or the way almost like people want to use agentic quite a lot, but I think still the sort of co-pilot model works very well, where you have you know, the human experts who essentially have this sort of orchestration of these AI agents, if you want to say, or LLMs, which can do a lot of the heavy lifting. And in this case, to answer your question specifically, you know, you'd need someone who understands exactly the behavioral piece to then make sure that these sort of agents are doing the right work with the right oversight. Otherwise, you know, you'll be getting all sorts of hallucinations.
Yeah,
And
can I
what,
just add to this?
yeah,
Sorry,
which
Eric.
behaviours are we looking for?
Sorry,
Sorry, go ahead.
Yeah, no, that's fine, because it links to your point, which is the expectation that I've always had is to do better. And in order to have a better, more efficient solution, behavioral analytics is really important. But in order to do that, you need a lot of data. So you're kind of going around in a circle. And I think it's really quite important to carefully consider what you are basing what you are benchmarking the behaviors that you are expecting, the behaviors that are not normal, that are anomalies, that you're going to actually mark for further investigation, for example. And
So-
that it really
so we're not
requires
just
an additional
entrenching-
human analysis. Sorry.
Are we not entrenching the big versus little debate? Because I can imagine that in a bank, there are a group of people that can draw in a psychologist and have big data and can go, that's a behavior pattern that we need to look at. Whereas for smaller organizations, they can't do that. They don't have the data, they don't have the people, they don't have the budget. Is not this direction forcing a split between those that can do, have bespoke, it's all great, and the rest of the market that's forced into a somewhat suboptimal vendor space, maybe, because they don't have the data, they don't have the people, and they don't have the budget?
Well, we're going back to the notion of proportionality to your risk, because if you are a smaller firm, chances are you're not offering the same product and carrying the same risk as a bigger institution. So there is a risk that you're going to have a less sophisticated solution, but that's not necessarily not appropriate with what you are trying to do. And maybe your clients are, you can try to segment your clients, but they're all in sort of the same, behaving in the same way. And you can address that in a more simple way than a bigger institution would need to do.
I would actually as well, just to add to that about the smaller versus larger, I think sometimes when you throw anything at a problem and expect X output, it's not always going to be the case. I reckon there's probably smaller businesses that still do, for example, communication surveillance manually, but they have really narrowed down exactly what they're trying to look for and narrowed down the risk, so that they're looking at alerts that are really specific, targeted. It's based on a model that kind of works to the risk-based approach. And then there's some larger businesses that, because they can throw people at a problem or technology or money, then they just have this whole host of alerts that are just going through the bureaucratic system through escalation, not actually being seen by the right people, and the right decisions aren't being made. So I don't think it's any solution in particular. I think back to all of this is risk appetite, tailoring processes and procedures. If there's a way to get tech enablement, use it, and if you're able to. Otherwise, make your human approach as clear as possible.
And do we run into a problem where a really good system for behavioral analytics, the moment the bad people find out what that is, they can subvert it? Yet the entire industry up and down needs to know what that is. So somebody discovers a marker in fraud between some funky trade that can be executed at the top level of the bank or through an investment trust, ETF, or hedge fund. Their obligation is to tell everybody, right? Because better AML, better source. But by that very disclosure, the bad people are going, oh, they've spotted that. Are we not always on the back foot in that environment?
Yes. I think
What
that's
can we
fair
do
to
about
say.
that?
So that's where having tools to help with all these changes and cope with these changes, that's part of the change. We find a problem, we find a solution. Someone is going to try and find another weakness and another way to get around it. That's pretty much the logic of it all. So it's I think information sharing is really still quite important, because you can find an institution that is somewhere in their journey really much advanced, has discovered something. If they do not actually disclose that, then no one else can sort of patch that issue and that gap. And so that's still very important to go. But then the criminals are going to get around it and know that this is not an avenue that they're pursuing, because they're going to go somewhere else. So that's the ever lasting problem, I would say.
I think just to add to that as well, there's also just a general point about, you know, reactive versus proactive, where a lot of these sort of criminals will be proactive and on the front foot in terms of taking action. And a lot of the time, you know, the defenses will be these systems and the compliance folks. So it's also like changing that mindset, you know, and that's like a much wider debate about the culture of compliance in these places, and whether, you know, can you get that extra spend to have that luxury of being proactive and saying, let's stay a step ahead, versus, okay, we've found a problem, as Marieke was saying, and now we've got to find a solution for it. I think there's also that cultural piece there.
Yeah, and it's intractable, right? Because Danske Bank, well-run Danish bank, some office in the middle of Estonia, laundered $200 billion, and they didn't even notice, right? That's a bank. So I think being a criminal pays. I mustn't tell my children that would be awful. So the issue, and that brings up another issue, is the fact that this industry seems to be really very siloed. Why is the industry so siloed? Marie, you've worked in the silo. How has it become so, and how do we break out of it?
Some of it is corporate history. People not generally like change, but also if they're not super secure in what they are trying to do, they tend not to share with other function, thinking that it is a purely them problem. So, for example, I've seen different situation when you had a market abuse issue, which turned out to be also a fraud issue, and that was not actually dealt with together. Or you can have a compliance issue around vulnerable clients who then become the victims of fraud. And then you have something there that you need to talk to other function and have that look. And it's the same communication surveillance, which in some institutions I've seen was considered a compliance problem, which actually detected some fraudulent behavior from clients or market abuse type of behavior. And working together works very well. But the reason to do that is because all the it's kind of historically, I think, compliance, that's my opinion, it might not be shared, but it's a very, as Eric said, it tended to be historically quite reactive based on a piece of legislation. So you would have a team that actually looks at this type of legislation and implements control around that specific one, and then another one who would look at something else, and then it sort of gets embedded into the organization. And I think that's one of the main drivers. And people tend to, when you have experts tend to look at their own expertise because that's what they're good at. And they not necessarily imagine another perspective and looking at that issue in another way, which would actually, then they would realize that there is another issue. So everybody is sort of in their box doing what they need to do. They have a lot to do and they have to focus. And this is, I think, where you end up with silos.
And Anastasia, you've worked in the more thrusting go hedge fund, smaller asset management industry. How have you found it there?
Yeah, it's interesting to hear from, the perspective of large institutions where it's very obvious siloed departments working on different financial crime areas. But the most interesting thing about smaller organizations or the mid-size space, certainly from my experience, is you really need to kind of empower the business to classify it as a problem for everyone. So I think traditional compliance with financial crime was definitely a compliance, or seen to be a compliance problem, even though it's not, not even under legislation. So it's about, for us, definitely as compliance professionals or in-house teams, it was about how can we remove mental silos rather than the actual physical silos, because we need the information from the rest of the business about what they're strategically moving towards, what goals they might have. But also when you're thinking about the proactive monitoring and kind of supporting the organization, it's also about removing silos so people can assist you, or other departments can assist you in, for example, integrating technological solutions. You need your IT department to understand the purpose so that they can actually help you get to the right solution, or perhaps even tell you, are you sure? When we looked at the model for this, it didn't make sense, and I don't think you're going to get to where you want to get to, or maybe we don't have the right data to feed into that technological solution for you to get the output. So I think silos is twofold. Number one, empowering everyone to be a financial crime fighter in-house, but also number two, actually getting that sponsorship and support so that people can help you be a proactive financial crime compliance person.
And I guess, to your point, in the smaller organizations, it's easier to be more joined up, because effectively you're all bonused the same way, you're all employees, there's only 40, 50, 100 of you. Whereas at HSBC, the IT department reports to the board, you report to the board, you can't get them to move at all, right? So I guess it's easier to do things in smaller firms, but doing the big things is more difficult because you don't have the resource. Whereas perversely, in a big organization, you've got loads of resource, just the IT department's not moving for toffee because they just don't.
Well put.
Not that I've got anything against IT in big organizations, just it has a degree of inertia. How much of it do we think is insider risk versus client supplier risk? Do we think that changes across? Arag, is that something that you've been able to identify from your horizon scanning? Are people even concerned about insider risk? Is that a thing in this area?
I think it depends on the use case in the company, as we were saying, and how it's proportional. I think those who are like heavily reliant on outsourcing, and by the way, we touched on this earlier about like how outsourcing needs to be more and more regulated. And with DORA, for example, in Europe, if you're a service provider of technological solutions, then you have to now be identified whether you're a critical vendor or not. So I definitely think that like there is more and more oversight coming into it to check whether the vendor risk is there. But I definitely think depending on like the type of organization, that there will be increased insider risk as well. I will defer to the experts on this though, because we're more on the the technological side. But Marique and Anastasia, I'm sure you guys have seen this on both sides actually. So I'll defer to you.
I guess insider risk means HR as well, which is a whole nother different kettle of fish in organizations. Have you seen extensive insider focus or not, Marika or Anastasia, or is that not on the horizon?
So I've seen it shift a little bit. I think there is more. It depends also on the size of the organization, that is true, because just the impact on the market, if we're talking about market abuse, for example, if you're in a bigger organization that has more impact on the market, you are going to look at your insider risk for that purpose in a more intense way, in a more focused way. Now, I have also seen insider risk in smaller institutions as well, smaller firms. And I think there is a tendency to be more turned towards the external risk first. And then when you have consolidated that, then you look at the insider list. If events don't actually provoke you to do that, because insider risk and having someone inside the institution who commits fraud, for example, is a risk that no one wants to, or is an event that no one wants to have to look at, quite frankly, because it's very distressing for the entire organization. But you tend to think that the people you work with that you have checked before they joined would actually not being fraudsters, for example. So this is like a second priority, but I've seen it shift because of high level, very public cases, for example, where you have someone selling information to an external fraudster, someone who is going to, and that's for every kind of firm, someone in the finance department, for example, paying out a completely different bank account than a provider, these kind of things. So I think there is, and now with the ECCTA, there is, I think, a little bit more focus that has to be on how the organization is set up. And then the priority was in the last few years, I would think. Anastasia, what do you think on that?
I'd say insider risk is definitely, as you say, especially those operating in public markets, is really important to look at that. And then in terms of the other financial crime, we're kind of back on the behavior analytics and monitoring. I think that's a really good source of data and information. But in terms of using that data and information, one of the things I remember when we were kind of integrating behavior type monitoring or comms surveillance or monitoring within the businesses I've worked at, one of the things that's kind of critical and around this insider point is ensuring if there is something that's highlighted or flagged, that somewhere within your procedures, you say when you are permitted to talk to that person about that case and where you're not, so that it doesn't fall into something like tipping off or that kind of thing. So I think processes and procedures around insiders are strangely probably lacking, because similarly to what you're saying, Marique, we kind of, for the most part, put it on a secondary level of monitoring.
There was that lovely FCA case where the IT person got nacked for being tipped off because they had to recover all of the emails for a MLRO, and unfortunately they got a little loose-lipped about it.
Yeah, exactly.
3 or 4 years ago. So the tipping off thing is a very real issue for SMF type, SM and CR type roles, because masters of the universe often don't know how to use the IT, and therefore making the IT person an insider happens, I think, probably more often than we would ever like to admit in any of these bits and pieces. Something that also smashes a hole in good process and breaking down silos and everything else is privacy, multi-jurisdictional regulations, GDPR, model clauses, doing business in Luxembourg or Germany, and the ethics of the systems that we use as decision-based systems with all their inherent biases and training and the rest of it. Arig, again, as our team AI expert, talk us through the bits and pieces, because you've referenced Revolut and the multi-jurisdictional thing. So you've obviously got the scars on your back of having to deal with Luxembourg and Germany.
Yeah, I think when it comes to multi-jurisdiction, the answer, which is maybe a bit more cynical, is that, you know, every regulator has to gold plate a little bit because that's what they're paid for. So you start getting a lot of different regulations. And, you know, a lot of people talk about Europe as being bad and US as not regulating. But actually, if you think about it, you know, in US, you've got 50 states. And so privacy is a great example there, where they're dealing with a lot of different state regulations across all those states. So companies are struggling with that as well. But to focus back on Europe, I definitely think that, you know, the volume of change is increasing, and there's been some polling recently across sort of compliance experts, and they expect this to go up. I think it was 60-something% saying they think that the regulatory volume is only going to increase. So dealing with all that is a massive challenge. To do that manually is almost impossible. And so again, it comes back to the risk-based approach. I mean, we know firms who have said that they're only reviewing, you know, the 20% high risk, or what they deem as high risk, and again, it's the proportionality principle. Just to touch on the ethical piece as well, with the EU AI Act coming out, it's really interesting that you touched on some of those things, and there are definitely clauses in there which focus on what type of use case you're using the models for. And if you do deal with things like credit data or personal data, then you have to be much more stringent in your sort of controls in place. And so that's already something which is being thought of quite heavily. And I think that's something that everyone needs to start thinking of when they're thinking of those use cases. For us, it's not a concern because we don't deal with that sort of data at the moment, but definitely something to keep on top of mind, I think.
Marie, in large organizations where you are dealing with a vast range of clients in various different regions, investing cross-border, with data privacy, redaction, right to be forgotten, regulatory frameworks, and the rest of it, how do you even begin to navigate that?
With difficulty, is the way I would put it. But this is why you have teams of experts trying to navigate that. So what I've seen in big institutions is that there is a strong incentive now with all the issues with different silos, but having all local jurisdiction doing their own thing, and then the headquarters did not know what was happening. So there is a very strong incentive to have something that is, if not identical, at least harmonized. But there is a very strong sort of incentive to try and gold plate as much as possible, so you cater for every type of situation, every type of institution. That from what I've seen doesn't work very well, because then you end up being so overly cautious that your processes are very complicated. You're asking your client actually more information than is needed, and then you have the whole problem around storing the data, using the data, how, etc. And you end up not being able to do things in certain jurisdictions that everybody else on the market is doing and that you need for your own regulatory purposes. So it's a very delicate balance, and it makes it slightly difficult to have a sort of uniform approach. You can't really have that. So it's a sort of very careful approach.
And so do you take the home regulator wins approach, or do you take the home data environment wins approach? Or Anastasia, when you're looking at risk analyzing this, where are you on this?
Yeah, in the financial crime space, especially because you have to handle so much data, a lot of the time, what's back to our very, very first point, I think, about outsourcing to administrators, you typically let them manage some of the problems that you then oversee to make sure that they're doing it by the way that you intend. But to map the way that you intend is quite tricky. And I think one of the things that you can do is map UK nexus versus cross-jurisdictional nexus. So sometimes, even though you're working with certain international firms, or you might have international subsidiaries, not all of them will have anything that qualifies as UK nexus, not maybe none of their operations, in fact, and vice versa. So mapping nexus, I think, is the first point, which is more a legislative point. Like, where would you be caught if you were to be in breach, or can you even be in breach of local jurisdictions internationally? So I think that's probably the best starting point, and working backwards from there.
And do you think there's a competitive advantage to regulatory jurisdiction shopping? So moving your high net worths to Dubai, where the oversight is less comprehensive than Switzerland used to be, or Isle of Man used to be. Do you think that firms are knowingly arbitraging the AML KYC regulations that way?
Undoubtedly, there will be bad actors if that's the reason that they're domiciling in places where there's lower regulatory friction. But at the end of the
every
day,
single high street bank is domiciling their high net worths in Dubai. I don't know why. They used to be in Switzerland. let's riddle
Their
that.
high net worth banking branches, or I guess you can't
private wealth. The private wealth for most of the named banks is now in Dubai rather than Switzerland.
And potentially for some clients, that would be a bonus. There's a lot of, when we're talking about B2B kind of business operations, so for example, within the kind of fund space, a lot of clients are themselves regulated in kind of stringent jurisdictions, and therefore kind of approaches to regulatory requirements and obligations, though you can facilitate some things more easily than others. Regardless, other businesses actually appreciate robust regulatory approaches in a proportionate way, if you can explain why. And I mean, we've seen it through the vast RFPs that institutional clients will give the funds that they're trying to invest in. So I think that a robust regulatory approach, at the end of the day, from an outcomes perspective, will win out in that B2B space.
Mm-hmm.
I will just add to that I think you can look at regulators as a product themselves, and they compete with each other, right? And depending on their own risk-based approach, they will have different sort of product features which might be more beneficial for certain companies. I mean, there's a reason why there are, by far and away more EMIs in Lithuania than anywhere else in Europe. It's not the weather. And the same thing why Luxembourg and Ireland compete for a lot of the funds as well, right? There are certain environments that they create which make it more beneficial for businesses to register there. So this is actually a competition across these countries, which we found really fascinating actually to follow.
And on your regulatory update radar, how many regulatory updates do you get from, say, the FCA versus the Cayman Financial Authority or the Bermuda Financial Authority or Aruba or any of the other well-known regulatory authorities where funds are domiciled for tax purposes, obviously tax purposes?
I don't have the volumes to hand, but I think what's interesting is it's not necessarily like the volume of updates which matter to a lot of the clients, but it's the underlying, you touched on it a few times, what are the tax implications, and what are like the regs, how stringent are they? Do they allow you to passport into other countries with minimal oversight? And I think that's where the differences happen. But if you take, for example, something like the Brazilian regulator, they will be releasing far more updates than the FCA. And so there are actually a lot of challenges which come with having regulators in different jurisdictions with different regulatory schedules. To your point, so it's very complex to see which regulators are more preferred, if that makes sense.
Absolutely. So everybody that's listening, we've got sort of 5-6 minutes left. So if you've got any questions, shove them in the Q&A bits and pieces, and we'll endeavour to ask them. Thank you all very much for joining. We'll see if we get any questions. If we don't, can you all just give us your predictions for this area moving forwards 12, 24 months? Do we think it's improving? Do we think it's something that we're always going to be on the back foot of because the financial criminals are always going to be better? Where do we think it's going to go? Marika, why don't we start with you?
Thank you. I think being on the back foot there is always going to be some element of it. It is going to be reactive. I'm expecting there to be more sort of sector-driven guidance coming out, a little bit more guidance also on what we mean by risk-based approach. And what I'm looking forward to as well is getting some sort of user case study on new systems, etc., to make things better, but also to sort of anticipate what the next move is going to be. So I think there's still a lot to do. There will always be a lot to do. But I think, it's a journey and we're all trying to improve matters. So I think it's a collective effort. I'm looking forward to that.
Perfect. Anastasia?
Thanks. Yeah, I guess geopolitical, geoeconomic stuff that will keep progressing. So I think the legislative environment will also keep progressing. But what I think will be interesting to see is as the level of change and the pace of change increases, whether actually financial crime teams or compliance teams are more proactive internally instead of kind of waiting for legislative change. Because I think otherwise you're always going to be on the back foot, like Marique said. The market's moving, well, the market's outpacing the regulator, and the regulator's outpacing the compliance teams. They're then meant to be monitoring the market. So I think to some extent, financial crime and compliance teams need to be working more closely internally rather than just monitoring the external environment, because that's also a very defensible approach when you're saying we're looking at the threat that's actually emerging from within our organization. And the other thing I think that will be a lot of progress on is the tech space, tech, financial crime, reg tech space. But I think what teams need to be aware of is tech isn't always the answer. Do your operational due diligence, make sure it's the right approach, test your processes, procedures first before embarking on a tech adventure to think that it will solve all your problems.
All right.
Yeah, as someone who's a big believer in tech, I think as we went from sort of paper-based to digital, I think there will be more and more adoption across, if you look at the three players, the criminals, the regulators, and the firms themselves. I think they're all going to be converging to, picking up the latest technologies. I think we're already seeing criminals using AI to fool systems. So then, of course, you'll need these companies to be able to battle that with the latest technology. And I also think that regulators will start, helping these firms by also picking up more and more technology, whether that is to monitor the firms under their supervision, whether that's to deliver, the changes, whether that's to unify it as much as possible to make it easier for the firms. But I do think that technology is going to be a key driver across all three of these, key players. And you'd like to think that, as always, like if you put enough people working together in the same room in the same direction, and they can sort of beat the criminals. I think one more interesting piece here will be whether these firms will start working together more and more. We always hear murmurings of this. I think that's still up in the air whether someone will actually break that cycle and start putting together that work.
And just to draw it all to a close, everybody here has had a fairly big life event this year. Marie, you're running your own business. Tell us a little bit about it.
Thank you. Yes, so I'm helping firms trying to navigate all of that, but more in the implementation and as a financial crime expert. And it's been a journey. It's been, for me, quite a transformative year, and I'm looking forward to the next one.
Perfect. Anastasia.
Yeah, kind of similar to Marique, I've set up this consultancy to kind of enable firms to look at the next 5-10 years and how moving alongside technology, enabling efficiencies within teams and businesses, and looking forward in a proactive way. So yeah, very excited for the next year.
Perfect. And Areg has qualified for something that maybe doesn't mean anything to Marique or Anastasia, but tell us about the YC stuff. That's amazing. Yeah,
so we went through the Y Combinator program around this time last year, which was just a brilliant opportunity. And essentially, we were working with the same folk who worked with people like Airbnb, Coinbase, Instacart, and more, and Dropbox. So it's a huge opportunity, and really using that as a platform to keep helping regulated businesses understand the regulations. So hopefully more of that in 2026.
And just let everyone know quite how impressive that is for an out of Bay Area founder to have got anywhere near YC, let alone be part of one of the cohorts.
I mean, it's not for me to say, but it's we try our best. We
pretty good. Anyway, thank you all very much indeed. I'm mind blown on AML and KYC. I think I'm going off to be a financial criminal because I think it's easier than trying to find the financial criminal. But I think we've got to keep on trucking. So thank you all very much for your time. And thank you everybody for watching. And be back soon for another compliance catch-up.
Thanks, James.
Thank you.
Thanks, Areg.